I think the mistake that a lot of investors make is they don't really ask questions. I don't know why that is. You don't have to be an expert. It's just that do the answers make sense? Generate 10 questions to ask the operator. And is the operator forthcoming? Right? If they're not forthcoming, why are they not forthcoming? Either they don't know, or they can't say, or don't want to say. And do the answers make sense?
Welcome to the Freedom Point Podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in.
Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer.
All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I'm so glad you're here with us again today. I've got another amazing guest. This one truly is amazing. I know all my guests are amazing, but this is the guy that I would maybe underscore, underline, hypothesize, whatever, amazing. Michael Blanc, welcome to the show.
Hey, it's great to be here, Jeremy.
So Michael Blanc is an entrepreneur and passionate about helping people become financially free with real estate investing. He's the author of the Amazon bestseller, Financial Freedom with Real Estate Investing, and host of his own popular podcast called Financial Freedom with Real Estate. He's helped investors purchase, get this, over 40,000 units valued at $1.5 billion through his training programs. Michael, you're no stranger to real estate investing. And so I'd love for you to maybe give our listening audience a little bit more information on Michael Blanc, your background, your journey, what you're focused on today, et cetera.
I'm also an expert in restaurant franchises because what happened is when I kind of followed the playbook like so many years. I went to school, got good grades, got a good job with benefits. And I found myself with a software startup in the late 90s. Because I have a highly educated, Jeremy. I have a master's in computer science. So I actually was a programmer. And it was one of the most successful software IPOs at the time. And it put a bunch of money in my pocket. Well, virtual money, because you're all locked up for 6 months. So you can't really sell anything. And the day later, we went public. Our CEO, Philip Merrick, opened up the NASDAQ. And that was the day the internet bubble popped. And so we saw our, sky high stock price kind of slowly kind of go back, down closer to zero. We actually had revenue. A lot of other .com. We actually had like $200 million in revenue in this company. Anyway, so I put a bunch of money in my pocket and I was coasting along until I read Rich Dad Poor Dad in 2004. 3 months later, I came home and told my wife I quit my job because I wanted to get me some financial freedom because that's what the book said. And it threw me for a major loop. And she goes, well, what's your plan? I said, well, I don't really have one, but we got a bunch of money. So nothing can possibly go wrong. And I did not get into multifamily or rentals or any of that. My big bet, which I told you now I'm an expert in franchise restaurants, was franchise restaurants. And it worked well for about a couple of years until the recession hit and then no longer worked very well at all. And I'll make a very, very long story short. I lost everything in the Great Recession. It took me a long time to extract myself out of these personally guaranteed leases. I had 8 restaurants at the time, and almost went back and got my job back, but instead decided to flip my way out of my financial debacle. And it was like the entrepreneurial nightmare because now I'm running these 6 restaurants because I had to fire my operator because I couldn't afford them anymore. And we're buying a house every month and flipping these houses. So I'm working literally 60 hours a week. I'm constantly in the car. Everything's at least an hour one way away. And I'm making nothing. I'm losing my shirt on the restaurants. I'm making chunks of money on the house flips, it was literally the entrepreneurial hamster wheel. And then in 2011, I accidentally got into an apartment building, which one of my wholesalers brought to me. And so I was like, that's interesting. I'll take a crack at it. And that was a complete nightmare. Like for next year and a half, I had a professional tenant in Washington, D.C. The guy was not paying rent, was suing me every 6 weeks. And I ran out of money. And luckily the market was going up at the time, thankfully. Otherwise, it would have been my first foreclosure. And that's kind of when the light bulb turned on when that quieted down a little bit and started sending me $1,500 in mailbox money. And now it's like, God, these restaurants are a nightmare. Flipping houses is a lot of work. But this building, which was super boring at one point because it just kind of sat there, And I was like, my gosh, but that's exactly what Kiyosaki talks about in the book. And so this idea of passive income took me literally 10 years to kind of figure out. And then I started pivoting into commercial real estate, multifamily specifically, raising money, teaching other people how to do it. And so today we have about $300 million in multifamily real estate. And my passion and mission is to help people become financially free with real estate, specifically with multifamily as well.
No, that's great. And I appreciate that backstory and background. Your background is somewhat similar to mine in the sense that we were both around, during the dot-com, days. I talk about this, in the past. I write about it in my book, this period of my life where I was in college and I was a day trader and I was trading, stocks on really borrowed money, which was, in other words, my college tuition, trading on margin. And when that bubble burst, right, not only did I experience some heavy losses, but those losses were exacerbated because I was trading on margin, and then, kind of that pivot into fixing and flipping, cutting my teeth, in the real estate space because I had an interest to get, into real estate. It sounds like, you did as well. I also, for 25 years, was in franchising. Okay. I was not a direct owner, but I was in the technology, sales space, providing back end office solutions to, franchise owners. So it's interesting that we have the same, or similar kind of background journey. The difference is between me and you is I pivoted more towards the passive side of being in real estate, whereas you pivoted, or you doubled down, I should say, really on the active side, going from flipping your way out of the financial crisis that you were in and really going into maybe the small multis or apartment, space. So really, maybe can you talk to our listening audience a little bit more about, kind of why you made that decision as opposed to, continuing to ride out a corporate, W-2 into the sunset?
Well, that was an easy one. Once I read Rich Dad Poor Dad, I immediately knew I didn't want to do that. So to me, because I was 30 at the time, I didn't want to. I did the idea of working another 30 years. Were like, oh, that's awful. Like I already worked 10, and it was a lot of fun. It really was. But I also know that going public, the probability of that happening again was close to zero. I know that. I just simply was watching the industry. And so to me, pursuing financial freedom was a priority. Now the question is, why did I get into active versus passive? That's a great question because I did have a bunch of money at the time. And what I learned during the Web Methods days is I actually have a more of a startup mentality. And I didn't learn that until I joined Web Methods. Actually, I was able to work on a lot of like startups within the startups. And I really liked it. I was very good at creating order from chaos, things that are not very well figured out. And I really enjoyed that. Now, having said that, I did make some passive investments, Jeremy, honestly, and they didn't go well. Like in the beginning, because I read Rich Dad Poor Dad, I had this humongous sense of urgency to deploy my capital to get passive income as quickly as possible. So I did actually make some investments, and I invested like 300 grand with a guy, and he had a really good reputation, but he lost all of it in like a year. Like he raised $1 million, of which mine was a third, and within a year, it was all gone. And he got investigated by the state SEC, and he got his wrist slapped. He couldn't raise money in Virginia for 5 years. I don't know. I don't know if it was a fraud or incompetence, but from that point forward, I had already been knee deep into restaurants because that was kind of my. And by the way, in my defense, just before you judge my active entrepreneurial plan, it was planned as a passive investment, Jeremy. Okay, the whole restaurant thing was not planned to be active. Okay, I followed the playbook. So in Northern Virginia, we had the Five Guys burgers, right? That's where it comes from. So I knew all the other franchisees, and I was like, "Oh, can I get a Five Guys burger?" No, you got to go to Minnesota, probably where you are. Like, okay, well, I'm in Virginia. I'm not going to wherever, Minnesota. And so they go, no, no, no. You pay the money, then you hire a guy, and you just sit back and count the passive income. And so it was set up that way. I hired a guy, multi-unit restaurant operator, and like I said, things went well until the recession hit, and yet again, you're dealing with something that's totally out of your control, and now it goes sideways. And sometimes the question is there really such a thing as a true passive investment? When that investment does not go well, who's going to be running that investment? Well, it was me. So it started passive and then turned active.
Yeah, so you were in effect making the decision to invest, really in yourself and take a risk on yourself as opposed to taking a risk, in a third party operator, to run and execute or effectuate the business plan. I want to talk to that individual, Michael, that gets stuck in this kind of phase, or I guess curse or blessing, depends on how you look at it, of analysis by paralysis or paralysis by analysis, right? I think there's one thing that's true about both you and I is we don't typically get stuck there, right? Once we get educated, we get confident, we align with the right people in the space that can help us, then you and I are both all about execution, 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 right? So can you talk specifically about those individuals that get stuck, in analysis paralysis, and what strategies do you teach those investors on moving forward confidently?
So I know what that's like because I'm an engineer. And now, luckily, I have two halves of my brain, and they're both about 50-50. So one fights the other constantly, and it comes out that I'm relatively balanced. Okay, relatively balanced. So I know this analysis paralysis because I was around people like that, and to some degree, I'm like that as well. On the other hand, I'm also someone who can take action, um, not so much without thinking, but I would say without clarity. So I want to talk to both the people who are stuck in paralysis and the other people who just kind of bumble forward like a freaking rhinoceros because they're both problematic. And I've done both, right? So the analysis paralysis stuff is really problematic because it serves various professions very well. Like if you're a surgeon, or let's say you're a builder, you're a good commercial builder, like you better have plans and everything's planned out to the T, because if not, buildings collapse and people die, right? So you need a plan. The blueprint's got to be done. Everything's got to be just so. But as an entrepreneur, that reality does not exist. It cannot exist. In other words, people who feel like they need everything up front will not be successful as an entrepreneur. So entrepreneurs have to deal with a certain amount of uncertainty. You can't have everything up front. So that does not mean you should go in uneducated and that you're a risk taker. Okay. I don't consider myself a gambler. I take calculated risks and I calculate probabilities in my head all the time. And I need just enough information to act on it. And so I think that's the thing that people need to get to the point where you're dealing with a certain amount of uncertainty. And the difference between the action takers and the ones that do not, everybody still is afraid. That emotion doesn't go away. When I do something, I'm still afraid. The difference is I act while other people do not act. I think that's number one. Now, having said that, the other side of the coin is simply acting without really thinking too much. And what I mean by that is really kind of creating clarity about the direction that you're working towards. So, example, when I started getting into house flipping, I didn't really think it through very much. I was like, I'd say, I need income. Let's flip a house. Let's flip another house. Let's flip a third house. And 3 years went by because I'm so busy now getting myself out of the restaurants and flipping houses. I never thought, well, is this actually financial freedom? Would this path actually get me to where I want to go? And a lot of people don't think about that. They're like, oh, I'm going to buy another rental. I'm going to flip another house. Yeah, but a rental only generates $200 a month. Like, especially passive investors, they go, oh, I'm going to get myself into real estate. Yeah, but your expenses are 20 grand a month. How is the $200 per month going to get you to 20 grand a month? Right? Oh, I didn't think about that. Right. And so the question really is, create some clarity for yourself. I think clarity is probably the biggest thing that people need to create. And then from that, then yes, move forward and overcome that analysis paralysis.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
So once you've got, clear, right, and you're willing to have clarity through this kind of chaos, right? What are maybe some of the major risk factors that investors that have never invested before, either actively or passively in real estate, what are some of those main risk factors that they need to mitigate for?
Well, it depends on who you're talking about. Let's talk about active or passive. Where do you want to go?
Let's go both.
Yeah. Well, so I would say so for both the foundation is probably education. Yeah, you can learn a lot through YouTube, and books. And I think that's pretty good for the passive side to one degree. For the active side, it's really not enough because, like, for example, we used to sell a $2,000 course, and it was literally epic because and we still have it today. It is amazingly epic, but I can drown you in knowledge and it still doesn't make you successful because you don't actually have the support around you. You don't have someone looking over your shoulder. You don't have a community around you. You don't have someone kicking your ass and holding you accountable. Well, you need all those three things. And then you're not in a network. If you're not in a network and I can't, have you raise money for me and I don't know you because I'm not in the wrong network, I'm not going to raise enough money. I can't, I'm not going to be close a deal. Or let's say I have access to capital and I don't have deal flow. I'm not in a network with operators in it. I don't even matter if I can have the best course. Okay. So in other words, you need to have the right team around you. You need to have some kind of system that you're following, and the right kind of support and the right kind of network. That's absolutely critical if you're going active. Now, if you do those things though, the results are dramatic. Like, you can buy a $4 million apartment building with one or two capital raisers that are raising $1 million, and now you're splitting $120,000 acquisition fee. Right, it's a lot more than $200 a month in a rental property. Now, on the passive side, it's a bit similar. Passive investors typically don't have the time to complete a 10-hour course, and nor that they don't need to. And it's a lot easier to understand an asset class. When I mean easier, you don't need hours and hours to try to understand asset class. You can ask chat, you can watch a YouTube videos, and you can learn about investing in multifamily or self storage. And I think that's much easier to do. I think the mistake that a lot of investors make is they don't really ask questions. I don't know why that is, but you don't have to be an expert. It's just that do the answers make sense? Yes, generate 10 questions to ask the operator. And is the operator forthcoming? Right? If they're not forthcoming, why are they not forthcoming? Either they don't know, or they can't say, or don't want to say. And do the answers make sense? Right? So, if I'm projecting, 10% year over year rent growth, why are they doing that? I mean, it might be correct, but why is that? What are you basing that on? Right? If you're, or another example, I have a 12-year fixed debt on a product, but I'm projecting a sale in year 5. Well, did you factor in, a yield maintenance or whatever early payment? Is that in your underwriting? Yes, it is. Okay, well, cool. Well, if it's not, it's a major oversight, right? Stuff like that. So just some questions that you can ask, and again, do the answers make sense, and how does the operator behave? And then I think put all that together with track record, and I think track record is really important. Um, as a partner, right? So there's a lot of these loose joint ventures, and it's the first time that these partners are doing a deal together. Well, that's cool. I don't care if they've all been around 10 years, but as a partnership, have they done a deal together yet? So how many deals have they done together? And at this point, have they navigated a down cycle? Were they around in 2008? What was that like? What about most recently? What's happening? How are you behaving? Things of that nature. I don't know. What do you think? What would you add to that?
No, I mean, it's spot on. And what's interesting about the last, few years, I'll say, in the space is you have this convergence of transparency and track record kind of coming together, right? Because most of the time when an operator presents their track record, it's either A, selective, or B, it really only includes sales at the peak of the last real estate market cycle. So we really ought to drill down specifically into, let's talk about the track record of the deals that you currently have under management today, or maybe deals that didn't go, as planned, that you're now choosing not to have a part of your track record. So I'd really like for you to talk to us a little bit more about kind of some of the recent shifts, as it relates to, things like interest rates, market sentiment. How has your acquisition, strategy evolved, over the past 12 to 18 months?
It's a difficult time that we're in, and I think this time does separate, the operators from us more like the wannabes. And the thing is, I would say most operators are experiencing some level of distress from one of the things that are going on. I mean, it's a distress from obviously the interest rates rising if they had variable rates. This distress from rents that have not really gone up in the last 2 years at all. Things of that nature. Distress from not being able to source deals. If they're sourcing deals, my gosh, how are they underwriting these deals? And so it's been a difficult environment. And so the question really is, how is that operator behaving and specifically communicating with their investors? I mean, no investor likes distributions to go to zero. No investor really likes capital calls. The question is, and there's a number of investors who are invested in multiple syndications, and they can tell you how one operator behaves differently from another operator. Like one operator is radio silent, and the other operator is communicating very well. And so how is that operator behaving? And I think it is going to be interesting, and it's something that we have to ask ourselves when we do present our deals. Do we present all of our deals? And how do we present them? I'm leaning towards more transparency on this, though. Having said that, it's difficult to do, right? Why talk about a deal that has gone bad when you can be silent on that deal? In other words, how do you talk about a deal that has gone bad? Because you don't want to spook investor either. But I think there's a way to do it. It requires a little bit more of a conversation. Why did this deal go bad? What happened? Well, the deal was 93% occupied, but the debt service was too high, right? And so therefore it didn't work out. It wasn't an operations issue, but we ended up, or we have not yet, but we could say, hey, let's say that the property returned to the bank for some reason. Well, here's what happened and here's why. Oh, okay. Okay, that makes sense, but it could scare some investors as well. So I think it's going to be really interesting how we position as an industry some of those deals. And I gotta say, I mean, operators that don't have any distress probably are lying.
Yeah, no, I 100% agree with you, on that. And, hopefully by now, most of those operators, have been, really exposed, right? But the truth is that every operator has some level or layer of distress if they purchased an asset at the peak of the last real estate market cycle. And I don't care if you bought, 5-year fixed agency financing or longer, or if it was floating rate bridge debt. I don't care if it was A class, B class, C class, it doesn't matter, right? If you bought an asset during the time period of June of 21 through July of 22, right, that 14-month, period of time, that asset is either currently undervalued today, possibly significantly, or, you're in financial distress, right? And so I always, like to challenge investors to say, he who is without distress cast the first stone. Okay. Because they're not out there. Right. And so I really think that's important for investors, to fully, understand that. But at the same token, Michael, where do we go from here? Because we know that people invest based on speculation. Okay. People were speculating back in 2016 that we were going to go into a recession. Well, guess what never happened from 2016 to 2021? There was no recession during that time period. And if you sat on the sidelines, you missed out on a 5-year bull run. Okay. Well, then people were speculating again in 2021. Things are just going to keep going up and to the right. Well, guess what happened? The bottom fell out, right? Because of the historic run up in interest rates and some of the other factors that we talked about. So the question isn't or shouldn't be about making decisions based on the last 18 to 24 months. We ought to be making decisions upon what we think the next 18 to 24 months are going to look like. And we need to do it in a way where we're mitigating against operation risk, execution risk, and market risk, the third of which is the most difficult to overcome.
Yes, but you're dealing with emotions. And if you study how people invest, it's either greed or fear, it's emotions. This explains the 2021-22 run up, right? I mean, even I was looking at it, where historic interest rates low, historically low, basically zero. The leverage was 80% loan to cost, not loan to value, but loan to cost. So the leverage was historically extremely high. But you're right. I mean, it's been going up for 5 years. There should have been a recession before then. It never came. Well, shoot, maybe it can go up a little higher. But from a risk profile, from a risk adjusted return, it was less favorable from a risk adjusted return because the risk for the same 15% IRR was relatively historically high. Okay, be that as it may. People were greedy back then, and so people threw everything out the window, and everybody got into multifamily. And so we got in, and pervasive sentiment was greed, 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 greed. Okay, now it's a bit opposite. Now it's fear, and it's normally, as Warren Buffett says, normally you should get out when there's a lot of greed in the market, and you should get in when there's a lot of fear in the market. Where right now there's a lot of fear, so logically maybe there's an opportunity, and maybe there is, maybe there isn't. But what I can observe is the risk profile, the risk adjusted return now is much better than it was 2.5 years ago. And this is because interest rates, the outlook is flat to down, mildly flat to down. Back then, we all knew that because it was at zero, it was up. We just had, no one could foretell it went up so quickly. But now, so the interest rate back then was essentially up. It wasn't flat up, it was up. Okay, now it's flat to down. Well, that's a better prognosis. Also, the loan proceeds we're getting is much, much lower than it was 2.5 years ago. So the risk is lower. Okay. We're also, no one's now doing variable rate unless they have a very, very expensive 5+ year rate cap on it. So no one is dumb enough to try to sell a syndication with a floating rate debt and a 2-year cap anymore. So that also is lower risk. So for the same 15% IRR, I'm assuming much, much lower risk. And it's got to be said, and some of the more sophisticated investors who actually have come back to the market have the ability to remove some of that emotion a little bit from their investing, and they're actually looking at the data, like I talked about now. And you couple that with what's coming. Okay, the outlook for multifamily specifically is very positive. It's not quite there yet. We've had a lot of apartments unit come out over the last 2 years from the free COVID money, but some of the metros like Dallas have been 100% absorbed, and you can see rents starting to tick up mildly again. And Atlanta, where we're at, the forecast is about the beginning of Q4, so we're another month or two away from that, when all the Class A is going to be absorbed, and then rents are going to go up from that as well. And if you look at the permits that are pulled, they're nowhere to be seen. No one's been pulling permits to build more apartment buildings because it's too daggone expensive. So all this absorption is done, population is rising, going up, and there's no more supply. So what's going to happen to the rent? Well, it's going to go up again, right? So I foresee next year that rents are going up at least a normal historical 2.5%, though there's an argument to be made that rents are going to go up more aggressively because of that thing. So I think the outlook for workforce housing is going to be very attractive because people need an affordable place to live, and I can't build any more of it.
Yeah, no, it makes total sense. And I fully agree with you, on kind of your outlook on organic, rent growth in the wake of, a limited amount of supply scheduled to come online, high absorption or strong absorption in certain markets. Of course, there's also concessions, right? Depending upon the market, you could have anywhere from 4 to 8 weeks worth of concessions. And I fully expect a lot of that, to get burned off, as absorption remains strong and new supply, really falls off a cliff, if that makes sense. I also appreciate your kind of perspective on this emotional, roller coaster, and, why it's really a prudent approach, to dollar cost average, your way, into real estate. Oftentimes I'm asked, Jeremy, you're in 40 investments, as an individual limited partner passive investor, and I've been investing since 2015. And I can tell you full well that I've had deals that have been absolute grand slams, and I've had deals where I've lost 100% of my money, as well. And so I think the prudent approach for investors is to not, have weak knees, understand that none of us really have a crystal ball, and the one that I had doesn't work anyways, right? And so it's really a good idea, for us to be prudent in our approach and to understand that there are different market cycles, and why it's of utmost importance to align yourself with an A class, best in class operator. All right. So beyond that, I just want to kind of have you, let our listeners know a little bit more about kind of this coaching program, specifically, helping students purchase over 40,000 units. What common traits or characteristics do you see, your successful students, embodying, versus that aren't succeeding in this space?
Yeah, it's interesting. It's not demographic. It's not even resources. It's not ethnicity or anything like that. It's really consistency. In fact, we have a guarantee that if you don't get a deal on a contract as a GP in 6 months, we work with you for free until you do. So, and we do that because we know that if people keep showing up and follow like our system, they're going to do a deal. The people that don't succeed are the ones that stop showing up for various different reasons. 2, 3, 4 months. Oh, something came up. It's taking a little more time than I want. I was really hoping to get something here in the next 30 days. Got a promotion at work. You know, that's weird. You just told me you want to be financial free, and now you're managing 100 people and you're traveling 3 out of 4 weeks. I'm confused. And so I think it's really consistency. And I think it's like that with almost anything in life. Anything meaningful you want to do, you want to lose weight, quit smoking, strengthen your relationships, you got to keep showing up. It's like you're married, right? Well, you get married one time, but every day you decide to stay married. Okay, it's consistency. It's the same thing. I want financial freedom. You got to keep showing up. And I really love what Hal Elrod talks about in the miracle equation. He kind of redefines goal setting. And a lot of people assign a deadline to a goal because we're taught to do that. But when I say, oh, I'm going to do my first deal next 12 months, well, there's too many variables in that. Why don't you commit to doing your first deal for as long as it takes, no matter what? And you commit to the activities that lead to that outcome. So in our world, it's analyzing deals and talking to investors. That's it. You do those things, analyzing deals, making offers, making offers, and you talk to investors. You do that long enough, and you're going to raise money. You're going to find a deal. That's it. And whether it takes 3 months or 18 months, who cares? And the people that commit to showing up every single day, doing a little bit every single day, those are the ones who are successful.
Yeah, that really truly is the secret sauce, is that consistency. So I'd like to maybe have you tell us a little bit more about, kind of this raising capital. I know that that's usually the biggest hurdle, I think, for most investors getting in the space is, yeah, they can underwrite 100 deals and hopefully get one under contract. They can follow, your coaching program and your playbook. But when it comes to raising capital, that's often a big hurdle, that they have to overcome. What's your best advice for building trust quickly with investors?
Well, let me just say that it is and it isn't. It depends on what kind of personality you are, what you have. So right now, everybody that comes through has to they learn the fundamentals of apartment building, how to find deals, how to talk to brokers, analyze deals, raise money. Okay, but as of about 6 months ago, we actually force you to pick a career track. You're either going to be a deal finder or a capital raiser. And the reason is because the personality is so different. A deal finder typically is a little bit more numbers oriented. They're going to gravitate to finding deals. And even though they don't like talking to brokers, the topic of conversation is numbers, and they like numbers. Okay. So they're going to be gravitating more towards deal flow, and they resist raising capital. They struggle with not so much the playbook, but simply talking to people. I don't want to beg people. They might say no. They might tell me to go away. And they don't like that. Okay. So for those people, we encourage them to network with capital raisers. Now, capital raisers have the opposite problem. They really don't like numbers. The sight of a spreadsheet makes them break out in a cold sweat, but they have the gift of gab. Their job, their background, their personality, they can talk to people. They just need a playbook. So for people like that, within 90 days, they got $500,000 raised. Okay, you just have to align the personality with a playbook, and they're like, oh, cool. I know how to talk to people. I just don't know what to say. Okay, now I know what to say. But they can't get deal flow because they really despise analyzing deals. So then we make them network with the deal finders, and we put them together, and now they're in a $4 million deal.
That makes total sense. So your coaching program is kind of one part an educational coaching mentoring program, but it's a two-part, in that you're really kind of a deal maker, deal matcher, right? Put the right people together and form a partnership, and they can grow.
Matchmaker.com. Yep, exactly.
That's great. Well, this has been a wonderful episode, Michael. What would maybe be, 2 or 3 different ways that our listening audience can learn more about you and to connect with you and your team offline?
Yeah, the great place to connect is thefreedompodcast.com/Jeremy. Okay, thefreedompodcast.com, Jeremy. And you can find out more about our podcast and our book on Amazon. If you're new to syndications, there's some resources there to help you introduce you to active investing and passive investing as well. So it's thefreedompodcast.com/Jeremy.
Wonderful. Well, we'll put that link in the show notes, and thank you for the special URL for our audience. Michael, this has been wonderful. Thanks for providing so much value to our audience today. And listening audience, thank you again for jumping into yet another episode of The Freedom Point. I look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting.